So, in an era dominated by these huge AI giants, can a company like BigBear.ai Holdings, a specialized defense contractor, can they really carve out a profitable niche? Or is its history, the financial instability, the operational missteps, is that going to stop it from grabbing this, well, generational market opportunity? Today, we're diving deep into your sources to figure out if the promise of BigBear.ai's future can actually, overcome the pretty daunting problems of its past. Welcome to the deep dive. Our mission here is to pull out the most important insights from this comprehensive analysis of BigBear.ai so you can be genuinely well informed.
That's right. And this analysis is current as of June 24, 2025. For context, at market close yesterday, June 23rd, BigBear.ai share price was $4.18. So our job today is to look at the company's business model, its leadership, its financial health, and crucially, the risks to really understand its investment merits. And it's important to remember, they went public through a SPAC merger back on December 8th, 2021.
Okay, let's get into it then. Diving right into the core of BigBear.ai's operations and the markets it's playing in.
Business and industry analysis. A niche player in a hyper-growth arena.
So BigBear.ai's core business, it's all about delivering decision dominance. What that basically means is operationalizing AI, taking complex data and turning it into, well, actionable insights. They've got this kind of hybrid model, right? Balancing those long-term government projects with a push towards more scalable commercial software.
Yeah, and looking at their 2024 results, that revenue model is interesting. Bit of a double-edged sword. They rely heavily on time and materials, T&M contracts, that's 56% of revenue. Those are stable, sure, billing by the hour, but it limits the operating leverage, the upside. Then you have fixed price FFP contracts, it's 29%. Those could offer cost efficiencies, but, and this is a big but, the company bears all the risk of cost overruns.
Right.
That's a major vulnerability when you're already struggling with costs. The rest is cost reimbursable, which limits risk but also caps profit. And of course, revenue from software licenses, maintenance, support. But here's a really critical vulnerability. Customer concentration. Just 4 customers made up over half, 52% of their 2024 consolidated revenues. That makes their performance incredibly sensitive.
Okay, so how do they actually achieve this decision dominance they talk about?
Well, their key stuff is built around this observe, orient, dominate platform. It's designed for edge networks, which means their AI processes data right where it's collected, think a drone, a remote sensor, instead of sending everything back to a central cloud. That's important. And their portfolio got a big boost in early 2024 when they bought Pangiam, a leader in vision AI.
Pangiam, right. What did they bring specifically?
A whole suite of advanced tech, digital identity management, so facial recognition, biometrics like Veriscan, TrueFace, really cutting-edge stuff, and also robust computer vision capabilities, using AI for image analysis, finding anomalies, threat detection. They also got ProModel, which is for digital twins, basically virtual models of physical systems for simulations, plus AI orchestration tools, cybersecurity tools. It's a big tech injection.
And it's worth highlighting that relationship they have with Palantir's Foundry platform. It sounds complicated.
Exactly. It's complicated. On one hand, Foundry gives them a sales channel, gives them validation, which is great. But on the other hand, Palantir is much, much bigger. They could easily develop their own competing modules, right? Which gives Palantir huge leverage. So BBAI's position is, yeah, symbiotic, but also, frankly, pretty precarious. And that customer concentration risk we mentioned is not just theoretical. Management specifically blamed the Virgin Orbit bankruptcy in 2023 for sluggish growth. It's a really stark reminder, isn't it? Even in high-tech AI, old-fashioned customer risk can really throw a wrench in the works.
So BigBear.ai, it's a small cap player, market cap around $1.22 billion right now. They're trying to position themselves as, more specialized, maybe more cost-effective than the giants like Palantir, but you have to ask. Do those persistent negative margins just completely undermine that whole cost advantage claim?
That's the core question. Their value proposition is deliver clarity for the world's most complex decisions. High-stakes customers, right? U.S. defense, intelligence, federal government primarily. But they're also pushing into commercial sectors, supply chains, logistics, travel.
Okay, let's zoom out a bit to the industry itself. You mentioned these twin tailwinds, AI in defense and AI in logistics.
Yeah, and the growth potential here, it's just massive. For AI in defense and security, forecasts are talking explosive growth. CGRs, compound annual growth rates, potentially hitting the 30% range. That translates to market sizes maybe well over $100 billion, maybe even closer to $180 billion by the early 2030s. Huge investments in autonomous systems, surveillance, predictive intelligence driving that. And AI in supply chain and logistics, that tailwind might be even stronger. CGR is forecasted from, say, 26% up to maybe 39%. Market sizes there could hit nearly $200 billion by the early 2030s,
Yeah.
driven by the absolute need for efficiency, resilience, automation.
Wow. Okay. Huge potential. But despite those massive tailwinds, the competition sounds intense. Crowded field.
Oh, it absolutely is. You've got direct AI and data analytics players like Palantir, C3.ai, SoundHound AI. And just for context, Palantir's got a positive net margin, nearly 20% TTM. BigBear.ai, deeply negative, minus 121%. That's a huge difference. Then you've got cybersecurity specialists like Sentinel, the big traditional defense primes, Lockheed Martin, RTX, and the IT services giants like IBM, Accenture. It's a tough crowd.
So given that competition and the fact they work so much with defense and intelligence, the regulatory environment must be pretty strict, right?
Absolutely. This isn't like launching a consumer app. Operating in defense and intelligence means dealing with a really stringent regulatory framework. You've got the Department of Defense's ethical AI principles. AI has to be responsible, equitable, traceable, reliable, governable. That's key. And they also have to follow international norms, like the U.S.-endorsed Political Declaration on Responsible Military Use of AI and Autonomy. It's serious business.
That sounds like it creates some pretty high walls for anyone trying to get into this space. What are these barriers, these moats protecting BigBear.ai?
Yeah, the barriers are formidable in defense and intelligence. That creates a significant moat. First, you've got formal security requirements. Getting clearances, that's non-negotiable. It takes time, costs a lot. Second, the tech and quality standards are incredibly high. Compliance with things like ISO 27001, NATO standards, difficult hurdles. Third, the procurement cycles are notoriously complex, slow, bureaucratic. You need huge upfront investment with absolutely no guarantee of winning the contract. And finally, building trust. Reputation with these cautious government agencies takes years, decades sometimes. New entrants can't just replicate that overnight.
So with all that considered, how does BigBear.ai actually stand out? Or does it? What's their real competitive advantage here?
Well, their moat is, I'd say, niche and narrow. They do have brand strength and recognition within the U.S. intelligence community and the DoD. That's valuable. The cost-effective positioning. Like we said, the negative margins really cast doubt on any actual cost advantage right now. Their strongest edge is probably switching costs. Once they're deeply integrated into a mission-critical government system, it's really hard and expensive for the client to rip them out and put someone else in. And finally, yeah, the Pangea merger did bring unique assets, that comprehensive vision AI, digital identity, biometrics expertise. That is a differentiator.
Okay, we've got a handle on the business and the market. Let's switch gears now and look at the people running the show management and how they're actually using the company's money.
Management and capital allocation evaluation.
Let's unpack these leadership changes because there's been some turbulence. Former CEO Mandy Long's tenure marked by some pretty significant issues, right? Famously missing those huge pre-merger revenue targets, projecting $550 million for 2024, but delivering only, $158 million? That's a massive miss, over 70%. And there was consistent insider selling during her time, too.
Yeah, that period was rough. The leadership change in January 2025 was absolutely pivotal. Kevin McAleenan taking over as CEO. It's effectively a strategic acqui-hire through that Pangea merger. McAleenan's background is, well, uniquely suited. Acting Secretary of Homeland Security, Commissioner of CBP. That gives him an unparalleled network and credibility in BigBear.ai's key markets. It strongly suggests the board paid a hefty price, including shareholder dilution, specifically to get him in charge.
Which brings us to transparency, or maybe the lack of it. Tell us about that major governance crisis they hit.
Right. In March 2025, they announced a big delay in filing their 10K, their annual report, and crucially, that they had to restate financials for 2022 and 2023. Why? Improper accounting for convertible notes. They admitted it themselves. A material weakness in its internal controls over financial reporting. That is a major, major red flag for investors. The stock dropped nearly 15% on the announcement. Now, the interim CFO, Sean Ricker, he's tasked with fixing it, but the damage to credibility is pretty substantial.
So how does all this turmoil affect how they actually spend money, their capital allocation?
Well, their capital allocation is laser focused on growth and, frankly, just survival. It's definitely not about returning capital to shareholders right now. The main M&A move was that $70 million all-stock acquisition of Pangea. They have ramped up R&D quite a bit from $1.1 million in Q1 2024 to $4.2 million in Q1 2025. But share buybacks, dividends, no history of either. Instead, they are what you'd call a serial issuer of equity. They heavily rely on at-the-market, or ATM, stock offerings and exercising warrants to get cash. Q1 2025 alone, they raised $64.7 million from warrants, but this comes at a direct cost. Continuous shareholder dilution. Existing shares just keep getting devalued.
So how effectively are they actually deploying all this capital they're raising and investing? We often look at ROIC for that.
It's exactly. Return on invested capital, ROIC. It shows how well a company uses its capital to generate profit. For BigBear.ai, it's bad. Severely and persistently negative. TTM ROIC is sitting at minus 63.1%. That indicates profound value destruction, not creation, if you look historically. Negative 30% in 2022, and negative 29% in 2023, negative 32% in 2024, now negative 63% TTM. It's consistently terrible. This is a really significant bearish indicator. It just shows they haven't been able to translate the capital they raise and invest into any kind of profit.
Okay, let's transition now to the really hard numbers, the financial analysis.
Financial analysis.
Let's break down the key metrics here, maybe starting with their market cap.
Sure. Market cap around $1.22 billion, like we said, puts it firmly in small cap territory, which usually means high volatility, and that's certainly true here. Now, revenue growth. This is where it gets really concerning. Stagnation and that dramatic failure to meet forecasts we talked about. Remember, $550 million projected for 2024. Actual was $158 million, if you look at historical revenue. $145.06 in 2021, then restated numbers of $155 in 2022, $155 in 2023, $158 in 2024. It's basically flatlined for 3 years around $150, $160 million. And that modest 5% year-over-year increase they showed in Q1 2025 to $34.8 million. That's mostly just the Pangeme acquisition kicking in. It suggests organic growth is near zero, maybe even negative. They're essentially buying top-line growth through these dilutive acquisitions, not generating it internally.
And what really stands out, as we've touched on, is the profitability picture, or lack thereof.
Yeah, profitability is just non-existent. Their gross margin, TTM, is 28.5%. That's pretty thin for a software company. Tells you they have high cost of revenue, likely due to those service-heavy government contracts. Operating margin, minus 33.8%. They lose about 34 cents for every single dollar of sales. And the net margin is staggering, minus 121.3%. They lost 1.21 for every dollar of revenue they brought in over the last 12 months. Historically, it's the same story, deep red net margins. Negative 85% in 2021, negative 72% in 2022, negative 46% in 2023, negative 187% in 2024. There is just no sign of improvement here.
So with margins like that, what does it mean for their free cash flow? Are they generating any cash?
Nope. Consistent cash burn. Persistently negative free cash flow, or FCF. Q1 2025 net cash from operations was negative $6.7 million. Free cash flow was negative $6.74 million. Compare that to Q1 2024, net cash from operations was negative $14.4 million. So maybe slightly less burn in Q1 25, but still significantly negative. The key takeaway is the company is absolutely not self-sustaining. It relies on continuous external capital, issuing stock, exercising warrants just to keep operating.
Okay, what about overall financial stability then?
Well, earnings consistency. Consistently negative. Significant net losses every year since going public. A $71 million loss in 2023, $62 million loss just in Q1 2025 alone. There's just no historical basis for predicting profitability anytime soon. Debt to equity is 0.56. That looks moderate on paper, but any debt is risky when you have negative earnings and negative cash flow like this. Their current ratio is 1.66. That seems healthy, right? But it's misleading. It's largely an artificial strength because of that recent $64.7 million cash injection from warrant exercises in Q1 2025. It props up the ratio. Dividend stability, non-existent. They don't pay dividends, which, given their financial state, is absolutely the right call.
Which brings us back to that crucial question, how on earth do you value a company like this?
It's really tough. With negative earnings, the price-to-earnings PE ratio is just meaningless. Doesn't apply. Their price-to-sales ratio, PS, is 7.61. That seems completely disconnected from the reality of their performance, right? A multiple like that implies massive future growth and profitability that just isn't backed up by anything in their history. So if you try an intrinsic valuation, like a discounted cash flow or DCF model, well, it becomes highly speculative, extremely sensitive to assumptions. You have to make truly heroic assumptions about a turnaround. You need optimistic revenue growth, maybe 15% for 5 years, then tapering. You need profitability to somehow systematically improve to maybe a 15-20% FCF margin, despite never showing any profit before. And you have to use a really high discount rate, your WACC, probably 12-15%, because the risk is extreme high beta, unprofitability, dilution, governance failures. Analyst commentary suggests a good price to buy might be closer to $3. So the current $4.18 looks significantly overvalued based on fundamentals.
All right, so we've laid out the company's foundation, the management issues, the pretty grim financials. Now let's shift to how the market actually perceives BigBear.ai and the huge risks it's facing.
Market sentiment and technical indicators.
Okay, market perception. This definitely seems like what you'd call a polarized story stock, doesn't it?
Absolutely. Analysts are all over the place. The consensus rating is technically a buy with an average price target of $4.83. That suggests about 15% upside from the current price. But the range is incredibly wide. Lowest target is $1.52. Highest is $6.30. That shows deep disagreement. And there have been recent downgrades too. So yeah, analysts are clearly divided on this one.
And it seems like this stock just lives and dies by headlines. How does news impact it, and what kind of volatility does that create?
Oh, the media narrative swings wildly. Positive catalysts, a new contract win, especially a big one with the U.S. Army, or maybe a strategic partnership, even just general good news about the AI sector can trigger really sharp rallies. But the flip side is just as dramatic. Poor financial results, missed expectations, that financial restatement we talked about, insider selling, all that leads to equally sharp declines. It creates this super volatile environment that seems driven more by the story, the narrative of the day, than by any underlying fundamental improvement.
So what do the market indicators tell us about this volatility and sentiment?
Well, it's clearly a heavily shorted, volatile battleground stock. Short interest is extremely high, somewhere between 22.5% and 23.15% of the float. That means nearly a quarter of the available shares are being bet against the company. That's a huge warning signal, typically coming from sophisticated market participants who've done their homework. Now, the days to cover is low, under 1 day. That means any potential short squeezes could be rapid, but likely short-lived. It's a technical event, not a sign of fundamental strength. Technically speaking, though, the price is currently trading above both its 50-day and 200-day simple moving averages. That usually indicates bullish short to medium and long-term momentum technically.
Interesting. Okay, let's dive into who actually owns this company, and maybe more importantly, who's been selling.
Ownership structure.
Let's break down the institutional ownership patterns. It sounds relatively low, but maybe some recent buying.
Institutional ownership is around 24%, maybe closer to 42% if you include passive index funds. The top holders are names like AE Industrial Partners, the original SPAC sponsor, BlackRock, Vanguard. What's maybe a bit encouraging is the recent trend. 177 institutions increased their holdings versus only 49 decreasing. And you see some big names popping up as recent buyers: Goldman Sachs, BNP Paribas, Citadel, even Renaissance Technologies. So some smart money is nibbling, perhaps betting on that turnaround story.
But then we look at the insiders, and that tells a completely different and frankly quite stark story, doesn't it?
Oh, absolutely. The insider transaction data is, well, it's an overwhelmingly bearish signal, just a torrent of selling, with virtually zero open market buying by insiders. Over the last 12 months, insiders sold something like 145.4 million shares. They only purchased about 4.9 million, and those were likely related to options or grants, not open market buys. In the last 6 months alone, 29 open market sales by insiders and 0 open market purchases. 0. And the most telling action, that aggressive selling by Pangiam Ultimate Holdings, LLC. That's the entity representing the former owners of Pangiam. They dumped over 70 million shares, worth around $251 million. That is just a massive vote of no confidence. It completely undermines the strategic rationale they gave for the merger in the first place. If the people who sold Pangiam are rushing for the exits, what does that tell you? You also saw selling from former CEO Amanda Long, former CFO Julie Peffer, and even the current Chief Accounting Officer Sean Ricker. It's pervasive.
So with all that insider selling, what does the ownership concentration look like now?
Well, AE Industrial Partners, the SPAC sponsor that brought them public, they're still the largest single shareholder. They hold about a 22% stake. That gives them significant influence over the company's direction, for better or worse.
Okay, let's shift our focus now to probably the most critical area for investors: risk. We'll use a SWOT analysis framework here. Strengths, weaknesses, opportunities, threats. Let's start with the shrink.
Risk assessment.
Right. So internal competencies, the strengths. First, those deep government roots. Established relationships, now potentially supercharged by the new CEO, Kevin McAleenan, with his background and connections. That's a real asset. Second, they do have a significant revenue backlog, $385 million as of the end of March 2025. That provides some near-term visibility, at least on the top line. Third, that differentiated technology portfolio, especially the Vision AI stuff they got from the Pangiam acquisition. And fourth, those high barriers to entry we discussed: the security clearances, the technical requirements, the trust needed in the defense sector. That does create a protective moat, however narrow.
Okay, but those strengths are balanced against some pretty serious internal limitations. The weaknesses.
Oh, absolutely. The weaknesses are critical here. Number one, chronic unprofitability. It's a long, unbroken history of net losses and burning cash. Number two, weak internal controls. That financial restatement and the material weakness admission, It just shatters confidence in their financial reporting. 3, high customer concentration. Makes those revenue streams fragile, very susceptible to shifts in government spending or losing just one key client. And 4, that heavy dependence on shareholder dilution. Their survival literally relies on constantly issuing new stock or warrants, which just continuously erodes the value for existing shareholders.
All right, let's look outwards now. What are the opportunities for BigBear.ai, assuming they can get their house in order?
Well, the market potential is undeniable. Massive total addressable markets, or TAMs. They're playing in AI in defense and AI in supply chain, both sectors projected for explosive double-digit growth for years to come. That's a huge tailwind. There's also the opportunity for cross-selling and finding synergies. Can they leverage that expanded portfolio from Pangiam across both their government and commercial clients? That's the hope. And finally, increased defense spending. Rising geopolitical tensions around the world could provide a really powerful tailwind for companies serving the defense sector.
So huge opportunities, but also significant external challenges, the threats.
Definitely. Threat number 1. Intense competition, relentless pressure from larger, profitable firms like Palantir, plus the traditional defense contractors, the IT giants. They all have far more resources than BigBear.ai. Threat number 2, government budget volatility. As a government contractor, they're always exposed to potential budget cuts, program delays, contract cancellations. It's inherent in the business. And threat number 3, linked to their financial weakness, inability to access capital. Their whole business model relies on tapping the capital markets. If sentiment turns negative, if the market door closes, they could face a serious liquidity crisis very quickly.
Let's connect this specifically to the bigger macroeconomic picture. How do things like high interest rates and inflation pose a direct threat?
They're a direct threat, absolutely. High interest rates make any future debt financing much more expensive. They also make equity investments less attractive generally, especially for risky, unprofitable companies. And persistent inflation. That directly hits their operating costs, labor, tech infrastructure. It's particularly damaging for those fixed price contracts we talked about.
Yeah.
If their costs go up but they can't pass them on, it just squeezes those already deeply negative margins even further.
And what about geopolitical factors, specifically those new U.S. tariffs implemented in 2025? How might they impact BigBear.ai?
Yeah, that's a tangible threat too, even though BBAI is mainly software focused. Their edge deployments, putting AI on sensors, drones, etc., often require hardware, servers, components. Many of these components come from global supply chains that are now hit by these broad U.S. tariffs, up to 50% on steel, aluminum, 10-15% on defense electronics, especially from China. So that directly increases their cost of goods sold, particularly on those fixed price deals where they absorb the hit. It just puts more pressure on margins. Just for context, a giant like RTX Corp warned these same tariffs could knock $850 million off their profits in 2025. So it's a real cost factor.
Wow, okay. We've covered a lot of ground today. Let's try and bring this all together now for our conclusion. Let's start with the bull case. Why might someone, despite everything we've just laid out, actually want to invest in BigBear.ai?
Well, the bull case boils down to a few key points. It's a pure-play AI company focused on national security and supply chain logistics to enormous, rapidly growing markets. That's the narrative appeal. They do have that substantial $385 million contract backlog, which gives some comfort about near-term revenue. And perhaps most importantly, you have the new CEO, Kevin McAleenan. His background offers potentially unparalleled credibility and access within their core government market. That's the change agent argument. So the bet is, if this turnaround actually works, if McAleenan can really leverage his connections and fix the operational issues, then maybe, just maybe, there's potential for exponential returns from its current small base. It's a high-risk, high-reward bet.
Okay, that's the hopeful view. Now, what's the flip side? The bear case, which sounds pretty grounded in the history we've discussed.
Yeah, the bear case is firmly grounded in that grim history of operational and financial failure, consistent failure to grow organically, persistent cash burn, profound value destruction shown by that terrible ROIC. The current valuation just seems completely detached from that reality. And then you have the two really damning factors. First, that financial restatement and the material weakness admission. It just shatters credibility around their numbers and controls. And second, that overwhelming, relentless insider selling, especially from the former Pangiam owners, is just such a profound vote of no confidence from the people who should know the acquired asset best. It screams, get out while you can.
So putting it all together, what's the bottom line on the valuation today?
Based on this analysis, BigBear.ai is assessed as significantly overvalued at its current share price of $4.18. Like we said, trying to build a DCF model for a company this unprofitable is just pure speculation. It requires heroic assumptions about growth and profitability that have zero historical precedent. Any reasonable DCF, using appropriate discount rates for the extreme risk involved, would likely yield an intrinsic value well below the current price, probably closer to that $3 mark, aligning with the more bearish analyst sentiment out there.
So BigBear.ai Holdings, it really presents this classic conflict, doesn't it? Between a really compelling story, a potentially huge market, and a very challenging reality. While it has that powerful growth narrative, the AI angle, the well-connected new CEO, its current share price seems to demand flawless execution and a rapid, dramatic pivot to profitability, something the company has simply never demonstrated it can do.
Exactly. The profound risks we've identified today, the chronic unprofitability, the weak governance highlighted by the restatement, that constant dependence on dilution, and, crucially, the overwhelming insider selling these factors significantly outweigh the speculative potential of the bull case narrative, at least at this current valuation. So our assessment remains significantly overvalued relative to its underlying fundamentals and historical performance.
So as you think about BigBear.ai, maybe consider this. What specific level of sustained operational improvement, what kind of consistent profitable contract wins would actually be needed to truly validate that bull case? And realistically, given their track record, how many years might that actually take?
And just the necessary disclaimer, this analysis was generated by an AI system for educational purposes and should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
If you found this deep dive valuable today, please do remember to like this video and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. And remember, members get priority deep dives on specific tickers for just $4.99 a month. We're actually covering all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those. Or if you'd like a one-off deep dive on a company of your choice, just drop us a super thanks. We appreciate the support.